Hey everyone, welcome to Breakout Wednesday for the 16th of April 2025. It's currently 8:30 a.m. on the West Coast, 10:30 a.m. on the East Coast. First of all, remember, this is not a financial advice, not a financial advisor. This is simply a video blog on how one trader sees the market, and everyone needs to take responsibility for their own decisions. All right, chart of the All Lords. Obviously, ABC correction, big rally, and now we're just chilling out, seeing what's going to happen in the crazy world that we're living in. But who knows about that? But let's just look where the money's flowing and what's happening. CBA, right? It's not that far off all-time highs, for God's sake. There's so much strength in this stock. Like the way it flushed out here. I was chatting to some guys the other day about on-balance volume and why I think it's a pretty shit indicator and how, I don't have on-balance volume on here, but it went down on this day here, that it's CBA gapped down on that market, hysteria day where everything gapped down. But it flushed out below these lows, rejected these lower prices, and to me, that's not a bearish day, right? The OBV went down, but to me, that's a bullish day, okay? Because it's flushing out and it's rejecting the prices and it's closing, a bit higher than it opened, and it's just not. I don't see how that's bearish at all. And it's rallied since then, and it's new all-time highs. Just compare that to like ANZ, below its 200-day. Compare that to NAB, below its 200-day. Compare that to Westpac, below its, right on its 200. Westpac's the second strongest, isn't it? It's just CBA so much strength, right? It's the most expensive bank in the world. But my argument is that it's for a reason. That it's the most expensive bank in the world. I want to own the best merchandise out there, not the shittest, cheapest crap, right? And so I like that I still got my positions on CBA, and I'm gonna keep them for now. And let's just go. The other stock I've been talking a bit on Breakout Wednesday is CMM, right? And on the forum. And I think during corrections like this, there's a lot of kind of people trying to pick up bargains, which is probably fine if you're buying the right stocks and companies and you understand them and you're in it for the long term. From the pure trading side of things for me though, yes, I do I like collecting good companies when they gap down and get hammered for sure. But in the trading account, I just don't do that. I just think that it's a loser's game in the trading account. And the trading account really is my focus. And in the trading account, it's it's the same thing for me. I'm just looking for this, right? Talked about this before. I won't go through it again and again and bore everyone. But just quickly for anyone that missed the talks, this didn't go down. It's really, really simple shit, right? This didn't go down to its 200-day. Didn't even get near it. It rejected all those big gap down days on the market. This thing just was strong. Opened on its low, closed on its high. Opened on its low, closed on its high. Kept doing it. Formed these tight little bases in an established uptrend, okay? In the best sector in the market right now, gold, boom, right? And it's really simple shit. But it's incredibly hard to trust yourself, isn't it? And to just take these signals. But in the trading account, this is what it's all about for me, right? Stuff, I don't bottom pick. I don't buy trend line bounces or moving average bounces or stupid Fibonacci or any of that dumb crap. No offense, right? 21 bit. I just don't think anyone makes money doing it. I think keep it simple. Trade like Mark Minervini and all those guys. Just wait for VCPs and strong uptrending stocks in your trading account and take them. Right? Simple as that, right? So that's a great example. Really is a great example. Next one is Sol, and Sol's probably not for my isn't for my trading account. It's for my long self-managed super fund account. But let's look at this on a monthly chart. All right. Wow. Okay. I don't even count how many months that is because it's shitloads. And this thing's just been going sideways. And obviously, some of you will know what the businesses Sol's in, but it's considered pretty Aussie-centric because they have a lot of businesses within the conglomerate that is not, it's kind of a roll-up business, right? They buy a whole bunch of different businesses from a whole bunch of different kind of industries, and they do a pretty good job in rolling them all up. And, they own stuff from swimming centers to education centers and all sorts of shit, right? But the point is that they're pretty immune to tariffs and overseas stuff. They're not exporters, right? They're not getting impacted by this Aussie dollar. They don't import, export. They're not impacted by tariffs. they just got great companies in Australia, pretty much. Okay, I think there's a few exceptions, but yeah, pretty much. You can read about them online. Obviously, some great articles out there. But getting back to it though, this huge base breaking out of the base. Now, there's anything I've learned since I started this, all those years ago. It's like big bases, sideways bases, just at the end of a correction, breaking out, just close your eyes and buy that sucker. And that's what I've done. And self-managed super fun, wide stop, trying to go for a big winner. And we'll see how that plays out. Another one, and Renee on the forum has been really kind of good on this. Where is he? Shit, sorry. Yeah, here we go. It's been posting about this for months, okay? And I only really kind of, I was a bit late to the party, but look at this on a weekly chart, just tightening up with blue sky above it. Healthcare sector, I mean, holy shit, that's all I need. I know that way over 50% of the time these things are going to be winners. And so it'd just be dumb for me not to take them. This is my job, right? Find the CMMs, find the regs, find the sols, and just keep taking them, and control my losses, let the winners run, and bang, you're just going to make bank year after year after year. It really is super, super simple when you just try and not complicate things. So there's another post on the forum, some really good people on this place. This is the one, SVR. Okay, I know a little bit about bloody alternative finance companies, and I do agree, like, this stock is outperforming the others. Like, if you look, I've been a long-term investor in Pepper Money. Shit, forgotten its bloody code, guys. I'm having a mind blank. 1 sec. Yeah, figured it out. PPM, not PMM. Bloody hell. And it's a bit like comparing CBA to ANZ and Westpac. Like, there's so much that there is more strength, and also more relative strength in SVR. And just the way it's bounced off these 200s, and it's got this base form in, and I see it, and it's got a huge dividend. These guys, they're very profitable companies. These little kind of lenders. If you want to get a car and you want to pay 12% interest, then these are your guys. You got to be a little bit of a sucker, don't you, to kind of sign up for that. But there's endless people that need it, I guess, and they need a job, so they don't mind paying the 12%. I guess it can make sense for some people, can't it? Anyway, that was an interesting one. I haven't made my mind up on that yet, because it's not really the technical setup that Sol or REG or CMM were, is it? But the other one is that I'm still in, and because I got caught on that gap down day like a bit, and so I trimmed a little bit of it, but it's like I got stuck in it. I'm not going to bore everyone, but I got stuck a bit in that. But then it's come back because it's pretty illiquid, right? You can't I don't want to just be hazy there. Like, it is hard to exit on some of these names all the time, right? Like, I shouldn't be getting stuck in these things, but it can be hard without really kind of punishing that price to get to get rid of everything pretty quickly. So I've held on, so I'm still got a decent chunk of this, and it's just showing great relative strength. Like, there are not that many names out there that aren't gold stocks that are sitting like this right behind, below all-time highs. Okay. All right. So before I just get to this scan I've been doing, just on the US market, I'm back looking at Duolingo. This is one I've been in and out of like countless times, and it's look, technically it's okay, right? It came down, bounced off. It's underflushed as 200 exponential. Bounced. Put in a high low, bounced, right? Forming these kind of 1, 2, 3 tests of this resistance here. It's got a gap here. It's still, it's in a good space. Like, I like that software space. It's relatively unaffected by obviously tariffs, right? It's not importing shit. It's just a software company, right? And I use Duolingo. I see my daughter using Duolingo a lot. She's 7 and she loves it. And it's like, I think it's, I know I don't know, it doesn't sound dumb, but it's like, I think looking at kids and teenagers and what they're into is like such a good way to figure out what stocks are real and are going to make it. Like, you know, it's fascinating. Like when you find a 15-year-old, you know, kid from 17 to 18 who's massively into a product, if that product's listed, just register that in the back of your head. It's classic Peter Lynch type shit, right? If you read his books, if you haven't, you should. Um, and he argues the same thing. He's like it's like once you're old, you know, once you're above say 40, you know, you're kind of out of touch with a lot of this new stuff. It's just facts, right? You can't help it. But if you can just be observant of what that younger generation are into, it's like when Lululemon was growing, you know. You know, I remember 10 years ago, well, more than that, shit, it's probably 13, when it had one of its first shops in Sydney, and I, you know, went into it one day, and there was just full of kids, you know, just women back then, because they only made women's stuff, and it was like, I never really heard of the brand, but I remember just seeing all these people in there thinking, shit, you know, what the hell's going on? And Duo, it's been like that. I think I've talked about this before, but you know, I think Duo definitely fits that bill, right? It's just widely used by the younger generation. So that's enough. Didn't mean to crap on too much about that. And then I'm just keeping an eye on Google. It's forming this massive channel, kind of wedge channel thing. You know, it fell down from the high of that wedge. I'm just interested to watch it. You know, will it come back down here and, you know, come around like that and keep consolidating under that, and then will I have an opportunity to kind of buy a break of it with a really tight stop and try and ride that, right? And that's not a CMM type trade in the sense that it's not a tight VCP with blue sky above it. And so my position on it and what I'd be risking of my account is always much lower than when I'm taking something that every box is ticked like that, okay? But in a market like this, in the big names that I have a bit of confidence in their long-term future, I will have some cracks, and it'll be like just paying a little bit at the poker table to kind of check out the next card, you know, and you pay a little bit, and if it's shit, you fold, you know. And it's the same with stocks. Like sometimes if I see a base like this and a setup like this and really good risk reward, I'll pay a little bit, you know, on a breakout, just test it with a tight stop, and if not working out, cut it. You take a really, really small loss, and then you have another crack, and then another crack. And it's all about, you just keep going until you get those big winners, right? And let them run. That's what it's about. And just quickly, the scan I've been doing mainly is relative strength stuff. I just think there is a holy grail. I think it really is the most underutilized thing. And since we went and put the relative strength in all our filters, there's no excuse, right? Like, I don't think I'm at that point now where like there's not much point in me scanning for stocks with a relative strength below 95, right? Sometimes I sit at 85 or 90, but definitely there's no reason for me to look at relative strength names below 80 unless I'm trying to short, which I've been done a few lately. But when I'm looking for stocks that can go up, which is 95% what I do, because stocks can go up a lot more than they can fall, obviously, you know. And so I've been doing this data scan a lot. 50 periods, 7 top, 3 bottom, any box, okay, close above it's 50 exponential, relative strength above 95, ignore results that have less than 250,000 shares traded, okay. I've been doing that on the NASDAQ, NISI, ASX, and I love it, all right. And then sometimes I've just been doing a plain old relative strength scan just with the indicators alone. Like if I've got a bit of time up my hand sleeve that I want to check out, so like that'll be like go into scans, go into say indicators and events. I did it last night, right? Go into events within, oh no, shit, that's not what I did. Sorry, let's just go up here, close above the 50, let's just put 50 exponential moving average. Then let's just put a filter of relative strength above 90 or 95, right? And then I've been doing that scan. Okay, it's a really simple scan, but I'm just looking for the relative strength names in uptrends. I've missed very, very few of the best setups with that, and so that's what I've been doing a lot lately. Okay, and that's it. It's good to knock this out a bit early in the day. I will make an effort to try and get it done early in the morning if I can. pending life getting in the way. Take care, everyone. Cheers.